Those are some of the mechanics, and of course, the associated recessionary risk is keeping investors on edge. Here to wrap up the week and preview the days ahead, Karl Shimada. Karl is Chief Market Strategist at Corpay. Nice to see you.
You as well.
Love this jacket.
Thank you.
Great color there. Murky colors for the Canadian economy going forward. We just reported on that retail sales data, which would suggest at the same time that the central bank is still boosting interest rates, that we're seeing signs of cooling in the economy.
That's right. Consumers clearly don't feel like they have enough green at this point. But, you know, I think it really was an interesting retail sales report in the sense that it sort of lifted spirits when you looked at the August number, and the September estimate is brutal. And so what it really sort of tells us here is that sort of consumer consumption engine that has been driving the Canadian economy is beginning to slow. If you look at it on a 3-month rolling average basis, it's definitely, you know, trending down. We're seeing less and less spending in Canada. And that, to a very large extent, is exactly what the Bank of Canada is looking to achieve. They're looking to cool aggregate demand. They're looking to cool the economy. That does appear to be translating into consumer buying patterns at this point.
Is that something that they have to communicate effectively to everyone when they have this interest rate decision next week?
Yes. So, you know, they're certainly going to make it explicit that they are trying to, you know, to sort of throw sand in the gears, I guess, is the best way to put it. They're not looking to, you know, trigger a cataclysmic collapse in confidence. So they're going to, you know, point to signs of resilience, particularly in employment and things like that. But they are going to project, especially in the monetary policy report, a slower growth trajectory next year. And so the assumption that they're making here is that with that and with, you know, tighter monetary policy, with rates rising, that they're going to force a adjustment in patterns across Canadian businesses and consumers. In other words, they're going to convince everyone to stop borrowing as much and to, you know, cut back that spending a little bit so that they can put downward pressure on inflation.
Two-part question as a follow. One, how aggressive do you think they are with a rate hike next week?
Coin toss. So I think this is really, really difficult to forecast. I do not have a strong conviction view here at all. You know, 50 basis points sounds highly likely. 75 is equally possible, particularly given, you know, Wednesday's inflation number and the fact that everyone expects the Fed to move by that increment. You know, when you take those into combination, I'd probably err on the side of a 75 basis point move, but then we very likely see a deceleration in December and into next year.
Okay, and, you know, 50, 75 after you've already seen 3 percentage points of hikes this year. And I don't mean to pick on the Bank of Canada, but you know, central banks, they were late to the game in addressing the inflation story. So as they get ready for another interest rate hike and they see some of the cooling effects that they may want, how do they also explain to the market that what they are doing is not going to take things over the cliff on the other side of this?
Right, and that's what central bankers have been trying to do. They've been pointing to the fact that that unemployment remains so low, that job openings are so high, that spending is so far above pre-pandemic levels. All of those things do tell you that you're looking at a strong underlying economy. However, markets always look through this stuff. Markets are always looking at the fact that you know, these indicators are typically lagging. They typically, you know, do not show signs of weakness until 12 to 24 months after an easing cycle, after a tightening cycle begins. You know, and markets are clearly implying what they see about the future when you look at the yield curve. The yield curve is deeply, deeply inverted. It's as deeply inverted as it has been since 1990. And so, you know, what that really tells us is that markets are positioning for a recession, even if the Bank of Canada and other central banks are trying to talk their way out of it.
How does that market positioning influence central banks? I mean, certainly we saw how it influenced government policy in the UK these last few days.
That's right. The bond vigilantes are back to some extent. I do think that in Canada, we are going to see more fiscal restraint in the months and years ahead on the basis of that UK example. You know, it's certainly obvious at this point that markets are not willing to absorb massive increases in indebtedness. They're not willing to fund sort of unfunded spending plans. They're not willing to do that anymore. However, for the Bank of Canada and for other central central banks, what they've clearly been telling us for the last year and a half really is that they're not willing to bow to the market's demands at any given point. They're going to try to bring inflation under control. That is their primary objective. They're less worried about financial stability risk. They're less worried about what the markets say about all this. They're more worried about what happens in the real economy. And that's a huge pivot. That's a huge psychological sea change, something that I would argue we probably haven't seen since the 90s, like since the early 90s. Greenspan would repeatedly bow down whenever we had that spike in yields, or if we had signs of turbulence in the markets. Today's crop of central bankers are looking all the way back to the 70s, and they're saying, you know what, we can't listen to that stuff. We have to stay focused on the mission.
Ironic to hear you say that, since the quickly, constantly changing UK government has tried to throw out words like economic stability as reasons for backing away from their original plan. I guess what I want to know about Canada is, during the pandemic, when we saw a changeover from Stephen Poloz, who joined us yesterday on BNN Bloomberg, to Tiff Macklem, you saw this united front, it felt like. I know it's church and state, but you saw sort of the government and our central bank working together to help the economy. Even if the central banks have a certain messaging, does there need to be more alignment with the government beyond just the government showing more fiscal restraint if we're going to get people calmer on inflation, on the recessionary risk, on all of these things?
Well, I think to some extent, the UK's example has influenced what we're going to see in the future from a communications perspective. We're going to see, politicians in particular try to stay, more closely aligned with that financial stability objective.
Yeah.
However, you and I have spoken for many years, right? And so all of those years, we've talked about this level of growing indebtedness in the Canadian economy, growing vulnerability. What we saw in the UK is a perfect textbook example of a sudden stop in international capital flows and domestic investment. And so what we could be facing in Canada is something very, very similar. So we need to tread very, very carefully in the years ahead. And I think policymakers are going to be very aware that they can't tip the apple cart here. They can't, trigger a situation where money flows out of Canada and Canadian households and businesses find themselves unable to borrow. Because if that happens, we can't roll over debt, we can't consume, we can't keep the economy going. So it's a very sort of dark and dangerous outlook right now.
We're almost out of time, but you did wear the greenish jacket here on this Friday. I know you're not an equity market person, but you talked about where the market itself is going. Is the sentiment such that it is accepting of where we are now, where we might be, and that changes the mood of the markets versus where we were 3 or 4 months ago?
I think to some extent, right? And the big factor that has been sort of keeping valuations aloft so far, at least, is the earnings picture, right? The fact that we are seeing companies having the pricing power, having the capacity to pass on these pressures. But, clearly with rates going up as they are, with Fed policymakers repeatedly telling us, where pressures are going, we are very likely looking at a bear market that continues to unfold in the months ahead, right? So it's sort of a bounce situation, as an equity strategist might think about it. It's a stock picking time. It's a time to look for the value where it is, but not to buy into the broader market trend, because it is very likely still going down. That's